Hey everyone, welcome to our fourth episode. At the end of the last video, I promised you we'd look at an example of journal entries and T accounts. So we have our consulting business example that we started with. Now let's apply the principles we learned in the last video. In our example, we had 3 transactions. If you're confused about how we decided what gets debited and credited, check out episode 2 in which we learned all about debits and credits. As you'll recall, our first transaction was receiving cash for services we performed. We saw using DED that we had to debit, cash, and credit revenue for $100. All we're going to do now is journalize this entry and record it in our T account. Let's start with our journal entry number, which will start with number 001. Let's just assume that all 3 of these transactions occurred on 1/1/21. So we can fill that in. Next, we have to list our accounts. I start with cash, and under debits, I'm going to put 100. Underneath, I'm going to slightly indent and write revenue with 100 under credits. Finally, I'm going to add a memo for this journal entry, which I'll simply put as to record the receipt of cash for services. That's all there is to journal entries. With our journal entry, let's now record the transaction into our T accounts. I'm going to go down to cash and put 100 in the left-hand column, along with 001 next to it, to record the transaction number. Then let's go over to revenue and put 100 on the right along with 001. There we have it. We went from accounting transaction to journal entry to T account, just like that. That's all there is to it, and that's one of the beauties of accounting. When we break things down into smaller parts, we can see it's not so hard after all. Let's take a look at the other 2 transactions and how we'll book the journal entries in T accounts. Our second entry was paying wages with cash. Our journal entry for this is going to follow the same pattern. We have our entry number, which we'll mark as 002. See how we're going in order? This helps us to serialize our entries, so we have a chronological order of events as they occurred. Our date again is 1/1/21. Our first account, as you'll remember, was wages. We debited wages $50. So under debits, we're going to put 50. And we credited cash $50. And under credit, we'll put 50. For our memo, let's put to record the payment of wages. The last step is to transfer the info from our journal entry to our T account. In our wages T account, we'll put $50 on the left-hand side, along with our entry number. And in our cash T account, we put $50 on the right side, along with our entry number. Finally, we have our final transaction, which is purchasing supplies on account. You might want to pause the video and see if you can figure out what the journal entry is going to look like. So we're going to put 003 for our journal entry number, and again, we have 1/1/21 for our date. The first account was supplies, and the second account was accounts payable. We have our amounts of $10 for supplies debited and $10 for accounts payable being credited. And lastly, we'll put for our memo to record the purchase of supplies. Now let's transfer the info into our T accounts. So we have $10 on the left for wages with our journal entry number. And on the right for accounts payable, we have $10 with our journal entry number again. And that's all 3 of our transactions journalized. The great part about T accounts are they help to keep track of the transactions throughout the period. This becomes clear when we take a look at the ending balances for each T account. We can do this very simply by adding up all of the debits and adding up all of the credits. Then we're just going to take the debit balance and subtract out the credit balance, which will leave us with our ending balance. Let's do that for each account, starting with cash. We had debits of $100 during the period, and we had credits of $50 during the period, leaving us with a net debit balance of $50. Now let's take a second to understand what this means. If we remember DED, which I'll put down below, we know that in order to increase expenses, assets, and dividends or draws, we have to debit these accounts. And anything other than these accounts, we have to credit to increase. So what exactly does it mean that cash has a $50 debit balance? Well, let's think about what we did logically. We know we received $100 in cash, and we know that we spent $50 in cash because we discussed this originally even before we booked our journal entries. We actually based our journal entries off these facts. So based on our 2 cash transactions, we know we should have $50 left over. And our T account is telling us that we have a $50 debit balance. So you can realize that the $50 debit balance in cash signifies that we have $50 in cash. And our T account is telling us that we have a $50 debit balance. So you can realize that the $50 debit balance in cash signifies that we have $50 in cash. This is what is known as a normal balance, which I'll put next to dead. Normal balances are based on the idea of dead. Expenses, assets, and dividends or draws have a normal debit balance, meaning a debit balance in any of these accounts we can think of almost as a positive number. Let's jump over revenue for a minute and take a look at our wages account, which is an expense account. If I think of dead, I know expenses get debited to increase them. Sure enough, our T account for wages shows a $50 debit balance, or a normal balance. And this makes sense, because think about the transaction that gave us this balance. We spent $50 to pay wages, so at the end of the period, we're reflecting a $50 debit balance. In other words, our T account is telling us we incurred $50 in wages expense. This is a normal balance. Think about if wages ended with a credit balance. It wouldn't make much sense because we'd essentially be saying we spent negative $50 paying people. Very rarely do we run into situations where we have negative expenses, and it usually only occurs when we end up getting reimbursed in a later period for an amount we spent in a prior period. Similarly with cash, if we had a credit balance of $50, we'd essentially be saying we have minus $50. And while this is a situation that can arise here and there, it generally doesn't make much sense. Hence the name normal balance. The last expense account we had was supplies, which has an ending debit balance of $10. Again, a normal balance. On the other side, we have revenue and accounts payable. Now, revenue and accounts payable are not under dead, so we know that we have to credit them to increase them. In the same way expenses, assets, and dividends or draws have a normal debit balance, all other accounts have a normal credit balance. Let's look at revenue. Our revenue T account has an ending balance of $100 credit. Or another way of writing that is minus $100. We know from our one transaction that we had received cash of $100 for our services, so we know we had $100 in revenue for the period. This is where it can be confusing. When we look at debit balances, it's easy to understand for expenses, assets, and dividends or draws. We see a positive or debit balance, and we can relate that to a positive amount of cash or a positive amount of expenses incurred. But when we look at revenue accounts or liability accounts, it doesn't always click for us. So our T account shows an ending balance of minus $100 for revenue. But what this really means is that we had $100 in revenue for the period. I understand it's confusing, but this is what makes truly grasping and memorizing dead so important. The other account we have is accounts payable, a liability, and it had an ending balance of $10 or minus 10. Again, we have to understand that a credit balance for a liability account is a normal balance. So minus $10 in accounts payable means we owe $10 to our creditors. Let's look at what our T accounts tell us about net income. We know logically that we received $100 in revenue and we paid $50 and $10 in expenses. In past videos, we had calculated our net income to be $40, just like we can do quite easily off the top of our heads right now. When we look at our T accounts though, what do we have? Well, we have minus $100 for revenue, and we have $50 for wages, and we have $10 for supplies, leaving us with a minus $40 balance for net income. And this makes sense when you think about it, right? Because what is net income but our remaining revenue after we subtract out our expenses? And if revenue has a normal credit balance, doesn't it follow that net income should also have a normal credit balance? So when we think about it in that way, our ending net income balance of $40 is actually telling us that we made $40 in net income. If we showed an ending debit balance of $40, we would actually have a net loss of $40. Conceptually, this is tough to grasp, so I encourage you to rewind, pause, think, rewatch the debits and credits videos. The first step to truly understanding, though, is memorizing DED, or whatever other mnemonic device that's going to help you figure this out. I want to wrap up with a somewhat lighter topic regarding journal entries. In the 3 journal entries we booked, they were relatively straightforward entries, only hitting 2 accounts each. There is no limit to the number of accounts a journal entry can affect. The only rule is that a minimum of 2 accounts must be hit, otherwise we'd have unequal debits and credits. For example, say we had an employee who made commission on a sale. We want to pay their regular wage, plus we're going to pay them their commission, in one check. We can do this all in one transaction very simply. First, we wanted to pay the employee wages, so we debit wages. But before we do that, we add our date, which we'll just put as 1/1/21, and a journal entry number we'll just make up as 1. Next, we wanted to pay commissions, which is also an expense. So I'm going to put commissions under wages. And since we know from DED they're both going to be debited, they line up on the same plane. Lastly, we have cash being credited. So I'm going to indent slightly. All we have to do is insert our debits and credits. So let's say we paid the employee $50 in wages and $50 in commissions for the period. So we're going to cut them a check of $100. We can see here 50 and 50, 100, and then we have 100 for credits. So our debits and credits tie. So this is a good transaction, a good journal entry. And the last thing we're going to do is to put a memo. So to pay wages and commissions. And that's it. Another video in which we've covered a lot of material. I can't stress enough that the concept of normal balances is so critically important to your understanding of accounting. Being able to look at account balances and understand what the data is telling you is a major foundational aspect of accounting, and it's truly a cornerstone of the profession. Study it, learn it, understand it. It will make your life so much easier down the road. But until next time, thanks for watching.